people upstairs, but we'll get started on the hour here. So I was expecting a bigger crowd today because of the topic, funding, money involved, but we'll take what we can get. So as many of you know by now, this is a sequence of workshops that all try to build on top of one another. Now in this session, we're going to tie in funding with the first workshop, which was on reality check, because now money is involved, therefore we have to do a reality check. But just to give you guys a sense of what these workshops involved, we started off with a sense of reality, historical data on anything to do with innovation and entrepreneurship. How do great entrepreneurs come up with ideas, great ideas to launch ventures with? How do they weed out the bad ideas quickly and efficiently, the quick kill methodology? How do they strategize about how are they going to position the company? Today we're going to talk about what's involved in raising money for a company. Now some of you may ask, how come you put financial projections underneath funding? Because we need to have our financial projections first before we can ask for money. I hope that by the end of today that question will be answered in your minds. And then how do we put this thing all together along with a story that goes along with all the numbers that we'll be discussing. So I'd like you to stare at this for a few minutes. I'm sure many of you are way too young to remember the George Foreman, Muhammad Ali game, the rope-a-dope. The dope was George Foreman, and Muhammad Ali just went to the corner of the ring and just waited there, and Foreman was a very powerful guy, punched him on the arms mostly, got completely tired, and I think it was like the 8th round or 9th round when Muhammad Ali knocked him out, and it was a big deal. So Muhammad Ali was deploying, strategy and so on and so forth. And so Mike Tyson actually said this. And I don't know, again, maybe you're even too young for Mike Tyson too. That would be extremely depressing. But Mike Tyson would just get out there and, you have a strategy. I'm going to do this and that to protect myself against Mike Tyson. And he would go in there and just destroy the person. Everybody has a plan until they get punched in the face. The corollary, the academic corollary of this would be a saying by Steve Blank, which is, no business plan survives first contact with the customer. Same thinking. So we need to prepare for this eventuality that you're going to go out there with a plan, and then the first thing that's going to happen to you is that you're going to get punched violently in the face, and you'll have to change your plan on the fly. So this is the dilemma that I have. Many of you know my students used to call me mentor and tormentor, and what I used to tell them is that I don't know how to pick winners, but I know how to pick at holes. So I'll pick at holes constantly for 9 months until I can't find any holes to pick at your business plan, and then we'll let you go through, and then you can talk to the real people who are going to part with their money. And the dilemma that I have is, how can I present reality as I perceive it based on data, not just feeling, and yet not discourage founders? So some of the things that I'll tell you right now today in this workshop may sound a little bit depressing, but that's obviously not my goal. My goal is to present you with reality, so that when this happens to you, that you will be a little bit more prepared in terms of handling that reality and still trying to win against Mr. Tyson, who's waiting out there for you. Okay, so let's start out with some reality then. So the reality is that 3 out of 4 startups that have been backed by venture capital, so they went through due diligence, and the masters of the universe who know everything, venture capital, invested in them, and yet 3 out of 4 of them fail. The source of this information is not, Mr. Smith off the street. It's a professor from Harvard Business School, so we're going to give him some credibility that hopefully he knows what he's talking about. But let's keep this in mind. 3 out of 4 startups, after getting venture capital money, fail. I promise I won't have too many of these baby pictures, but I kind of like them actually, so there'll be a few more and then it'll stop. If we define failure as not reaching the return on investment that you promised your investors at the beginning when they were investing in you, 95% of startups failed, if we define it that way. One more baby picture. Now, this is consistent data that comes over and over again. This is from a paper, 2008. 73% of startups end up with an exit value of $0. 73%. And then we'll look at the other exits. These are venture capital-backed companies. Exit of 0 to 3 million, 4%. 3 to 6 million, 4%. 6 to 12% million, 4%, etc., etc. So we are into a extremely difficult game, no question about it. Okay? Now we're going to talk about the implications of this on how we as founders have to position ourselves. How do we negotiate with investors? What are the investors thinking on the other side? What happens when you put the investor's hat on? What is he thinking is the type of stuff that we'll cover. I guess before I got to this point, I should have asked first, is there a venture capitalist in the audience, in case I insult them any further? None? Seeing none, I will continue to pick on them a little bit. Because when you ask VC, so what's going on? Are you guys only correct, 25% of the time? I thought you guys were spectacular, with all these degrees and so on. What happened? So the typical answer depends on where you are. If you're from the two coasts, Silicon Valley, New York, Massachusetts, Austin, the returns are polarized. Some VCs are doing very well, and then the middle of the country is not doing so well. The average return for VCs over a 10-year window is 0%. So there's a few outliers who are delivering great results, and then the rest of the country is not doing so well. So we should all keep this in the back of our mind. Now, this is not an error or any kind of, stupidity, lack of knowledge, or chutzpah, or anything like that. These are all reality-based statistics. The area of medicine gives us the ability to look at risk factors. So you may not be familiar with this terminology, but a particular type of drug, and given its stage of testing, it's been tested in small animals, it's been tested for safety in human beings, etc., etc. At this stage of the game, for example, the approval success rate, historical approval success rate is 24%, 21%, 18%, 22%, etc., etc. So we have some means of determining, at least in the area of medicine, what is the historical success rate associated with the development of products. Similarly, in the drug business, things go through phases, safety test, efficacy test, large patient population test, etc. And these are the probabilities, historical data-based probabilities, of moving from the end of a phase 2 test to a phase 3 test on the basis of different type of disease areas. So you can be assured that venture capital and angel investors are watching these numbers like a hawk, because that's what they're determining, what type of a deal term that they're going to give to you. How will they make a decision on whether to fund you, and if so, when to fund you and how much to fund you. All of this we're going to cover in this workshop. So the bottom line is human nature, as always, is the dominant thing at play here, right? Even though we try to cover it with numbers and so on and so forth. Bottom line is a struggle between fear and greed, between risk and reward, and a strategy of thinking big but starting small. If you remember only one thing from this class, which all good teachers tell me to say, if you remember one thing from this class, you should remember this. You have to think, in order to raise funding, typically, almost always, you have to paint a big picture, but you have to start small. Why? Because if you cannot win here, there is no sense in you going after this. First, demonstrate to me a small area where you can show a win. The lowest hanging fruit, the easiest market possible. If you can't win there, then why go on? Why waste other people's resources, your own resources and time? So this is where all the investors are scared little rabbits, terrified that you're going to be one of those 75% of companies that we thought was going to win and did not win. Demonstrate to me that you have the ability to win, and then greed takes over once you go through this fear mode. Okay, it's got shown some traction, other people are investing in it. How big can we make this company? And that's on the reward side, right? So risk, initial risk, terrified investors, de-risked, risk has come down. Now people looking for how big can we make this company. That is what is at play at a fundamental psychological level. I've shown this in other places too. So how do we beat these odds? Without patting myself in the back, I'm just going to make a statement of fact. So what I did was I started 3 companies and I was able to exit each of them sequentially. 7 years, from 1994 to 2000, one company, sold it to a public company. 2000 to 2007, built up another company, sold it to an Irish private equity firm, and then in the middle there formed another company and sold it to the same public company that I sold the first company to. A great exit strategy. So instead of saying, oh boy, I must be really smart, which I know I'm not, I thought, okay, what did I do correctly to get this to happen when the statistics were all against me? How did I beat the odds? And I'm 100% convinced that in order to beat the odds, you have to have nothing less than the combination of these two. If you are the smartest person in the world IQ-wise, and you know all the analysis, like most of our students here at WashU, you can figure out anything you like, but you don't have these and all of these, most likely you're going to fail at entrepreneurship. If you have all of these, you're passionate, you're gung-ho, I'm going to do it regardless what happens, etc., and then you don't have the ability to do this cold analysis and cold decision-making capability, you're going to fail. So if you don't have both of those within you, then what you need to do is to surround yourself with people who cover both sides of the equation in order to win. I'm repeating myself from some of the prior workshops, but these are important things, right? So we can just read these and say, okay, blah, 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 but in the real world, when you're out there, this combination of self-confidence and humility, for example, is so important and so difficult. You can't fake it. You either have it or you don't have it. Or knowing what you do not know. I face this every day with our scientists at Washington University. Because they know this topic incredibly well, then by definition, they must know all topics very well, but they don't. And if they don't know what they do not know, as an investor, I'm out instantly. I don't care how fantastic the technology is, I'm out. So these are the type of things that break the odds for us. At the top there is something that I used to tell my wife when we had our own companies. Honestly, I said 95% of what I'm doing is psychology and 5% is everything else. So if I were to pick one of these sides, I said both are necessary. This side is even more important. And I can give you all sorts of, anecdotal stories about how things on this side made the big difference, huge difference. Like in terms of how much money I was able to get when I sold my company was on this side. It's all about human psychology. And then the rest of it is the glue that ties everything else together. Similarly, on this side, to beat the odds, you can be the best chess player in the world, see 18 moves ahead, strategize perfectly. If you can't play poker, you're going to lose. You have to be able to win with a weak hand at entrepreneurship. And again, these things are just words, but in real life, they hit us like the Mike Tyson picture that I showed you. You don't get hit by Mike Tyson from this side of the fence, right? The hit comes from this side of the fence. Okay. Now I'm going to switch gears a little bit for you. We're going to go a little bit numerical on you, okay? But we're going to keep it very common sense. So please stop me at any point. In fact, after each slide, I should just stop and then solicit some questions and some feedback from you. Now we're going to tie these numbers together a little bit in a very concrete way. At the tail end, what we're going to come up with is how an investor thinks in a particular case about, should I invest in this? If so, how much should I invest in this? How are those decisions made in the investor's brain is our endpoint. I want you to imagine that you're issuing a new credit card to a population. And what you know is that the historical default rate for that population is 75%. Meaning 75% of the people to whom you give this credit card are not going to pay back the loan. Okay? Easy enough to imagine. The corollary is the historical default rate for startups is also 75%, as I showed in the prior slide. So keep that in the back of your mind also. Now my question to you is, how much would you have to charge in annual interest rate on those credit cards just to break even, just to make what they call risk-free interest rate? You know 75% of them are going to fail. How much interest would you have to charge on a credit card to just break even? So people luckily have studied this, unless if somebody knows the answer. Anybody know the answer? Anybody want to guess? I usually don't play those games of, guess, oh, you're wrong, you're right. Let's just get to the equation, right? So the equation is this. The risk-free interest rate today is essentially zero, right? If you buy a CD, 0.5% per year, whatever. This is the default rate. And here is the interest rate that we need to charge people to just break even. And the number comes out to 316% per year. If I give you $1, if you have a 75%, I don't care how good you are. Everybody's good when they come to me, and they all say, trust me, I won't default. But historical data says, I don't know which ones of you are going to default, but I know 75% of you are going to default. So to protect myself, I need to charge you 300% annual interest rate. So one would call that usury, right? You're charging too much, 300%. What a greedy person. Is it really greed, or is it just the outcome of mathematics? I would argue it's the outcome of mathematics. So I give you $1, next year I want, $3. But I'm so good. You're lumping me up with all these other people. Why? Because all the other people are also telling me exactly what you're telling me. That all of them are also extremely good. Keep this number in mind, 300% per year in interest if the default rate is 75%. So let's say, okay, well, that's just theory. How about reality? So let's pick some unsecured loans and see what interest rate is charged by the industry as a function of the known default rate. So these are real data points of unsecured loans versus default rate. And unfortunately, ours is way out there, so I plotted these numbers and put in a best curve and so on. By the way, I have never taken a business class. I'm a pure engineer, so take everything I say with a grain of salt. I don't have an MBA, admit that too. Any MBAs in the class? Can I also start picking on them too? Excellent. Okay, so if we extrapolated from reality as opposed to the calculation, 140% per year. Okay, between 140% and 300%. Now we need to translate this into the language of investment. So investors are not in the business of collecting interest. They're not banks. What they're after is to invest some money in you, build your company, sell the company to another company, or have an IPO, initial public offering, make a large amount of money, and then pay me back a lump sum amount of money. So we're not in the business of collecting interest. We're not banks. We just want an exit event is what it's called. Company is sold, and I get my share of that company. So the language that we use instead of interest rate is something called internal rate of return. You don't have to remember it, IRR, internal rate of return. And the only difference between interest rate and internal rate of return is the time factor. So I invested in your company, and it took you 5 years to sell the company and then give me back some money back because of the equity I own in your company, versus it took you 12 years to sell the company. Even though I got the same amount of money back, the internal rate of return is different because in one case I had to wait for 12 years, in another case I had to wait only for 5 years. Make sense? Right? So I made an investment. I'm going to get some lump sum back in 5 years versus 8 years. Which one are you going to pick? You're going to pick the one in 5 years. Because why? Your internal rate of return is higher if the exit is closer. So I picked, the theory said 300% and extrapolation said 140. I picked 200. But you pick any number you want. I'll give you an Excel that you can enter that number into. So I picked 200%. The first step is, what should be my expected internal rate of return? It should be 200% per year. With me so far? Did I lose anybody at all? 200% expected internal rate of return. Expected on the basis of what? On the basis of risk assessment. What is the risk assessment based on? The tyranny of historical data for the time being. But we are assessing, we're desperately trying to find means of assessing risk. The easiest thing that we have is historical data to start with. Now I'm going to convert this internal rate of return into a return on investment expectation. And this is also a mathematical step that I'm going to take. If I need to have 200% internal rate of return, and your projections show me that we're going to sell this company in 5 years, then I should anticipate getting 80 times my original investment back when you sell the company, when you exit. Again, all rational thinking. I mean, if you were to put yourselves in the shoes of investors, would you agree with this type of logic? Anybody see any flaw in the logic so far? Anything that you would object to as founders? Because if you're not objecting, the end result is going to be really bad for founders. So better object now if you see any kind of logical flaw. So, good question. So how is the question? And there are Excel formulas. So I get lazy, right? So instead of the equation, this is from this site, which I verified to be viable. So what you do is you say, if I put in -1 in year number 1 and get no return, no return, no return, and then I get 81 times my money, then the internal rate of return is 200%. So by trial and error, I put different numbers in here until I got an IRR of 200. And then I said, okay, return on investment should be 80. I could probably do it closed loop, but why waste time, right? So this was much, much quicker. So the translation from expected internal rate of return, which is first determined, to expected return on investment. You can use this, you can use Excel, you can calculate it yourself. If it was year number 6, it would have been a different number. So the key assumption here is I'm assuming that you have persuaded me as a founder that we're going to exit in year number 5. So I expect an 80-fold return on the money that I invest for reasons that I explained before. Now, based on that, the next thing that I'm going to calculate is a term called post-money value of the business. What does that mean? The word implies it by itself. Post-money is the value of your company after an investment has been made in it. So post-money, post-investment, the value of your company after an investment is made in it is the post-money. So this is now what I need to calculate, the post-money valuation, for which I need to talk to you as a founder and come to an agreement on, if it so happens that you're not in the 75% that will fail, and it so happens that you're in the 25% that win, how much can we sell this company for 5 years down the line? Right? So you didn't die. Now on the reward side, on the greed side, how much can we sell this company for? This is all negotiation between a founder and an investor. Back and forth, back and forth, back and forth. A matter of persuasion. Let's say that we collectively agreed that you can build a company that we can sell for $50 million in 5 years. And I agree with it if you're not in the 75% that will go belly up. Right? So I'll say, okay, let's suppose that you were correct. You're in the 25%, and we're going to sell this company for $50 million. This is the formula that we use. Post-money valuation, the way we will calculate it is the exit value of the company, the amount of money that the company is sold for, divided by my expectation of return on investment. Let me put a specific case here so that I don't lose anybody. We said, we agreed with you. You and I agreed as investor and founder that this company can be sold for $50 million. And my return on investment expectation is 80 times. Therefore, I say to you as an investor, I am going to say that the value of your company after I make the investment is $50 million divided by 80, $625,000. So that will be my starting point of the negotiations with you. And I'm going to show you all my reasoning as to why I reached that conclusion. And hopefully I'll leave you, no holes so that it will be a solid argument that I'm making to you. What are the variables? Obviously, if this number is bigger and you can convince me that this number is bigger, then I'll give a higher valuation to your company. Now, why is this valuation of the company so important? It's important because it will determine the thing that you see on Shark Tank, which is, I'll give you $10,000 for 10% of your company. Hidden underneath all of that is all these calculations, actually. Except that because it's on TV, we have to have very simple language. I'll give you $10,000 for 10% of your company. But that implies that that offer implies that the post-money valuation of the company is $10,000 for 10%, $100,000. So he's assigning a valuation to the company, actually. But bear with me here for 2 more seconds. Now from this, we came this far. We determined the post-money valuation of the company, $625,000. The next question that I asked the founder is, how much money do you need at this stage? At this moment in time, how much money do you need? And he says, let's say $50,000, because I'm at the very early stages, I need to demonstrate some things. $50,000 is what I need. If he needed $500,000 or $1 million, the conversation would end, because I would have taken over more than half of his company, which is not what I want to do as an investor, because the next thing that will happen is the moment he's upset, he's going to leave, and I don't want to run his company. So investors typically do not want to take over a large chunk of the company, because it's the founder who's going to execute. So typically we'll take 20% of the company, no more. But there's a difference between ownership and control. You can own 20% of a company, but you can have total veto power over any decision that the company makes. And that's the type of agreements that we come to. Now let's go to investors' proposed deal terms, for which we need to find out what the pre-money valuation is. So we said post-money valuation was after the investment. So post-money valuation minus the investment that you're seeking is the so-called pre-money valuation, pre-investment valuation of the company. I'm going to put this in context in just a few more seconds with lots of examples so it will become clearer. But the pre-money valuation is, I have an idea. I need $50,000. My question to the founder is, how much is your idea worth? The question that I'm asking is, what's your pre-money valuation? Now another one comes in and says, I have an idea and I have a prototype and it seems to work. Okay, how much is your company worth? Looking for a pre-money valuation. We're trying to gauge what the risk level is. I have an idea, I have a prototype, and then I have a letter of intent to purchase from a customer. De-risk, de-risk, de-risk. Up goes the pre-money valuation. Why is this important to you as a founder? It's important to you as a founder because the percentage of the company owned by the investor. So I have an investor who puts up $50,000, and we came to the conclusion that your company valuation before I made the investment was $450,000. What that means is that the investor is going to own, when he puts up this $50,000, he's going to own $50,000 divided by post-money. So pre-money plus the investor's investment. So 450 plus 50, 10%. So when somebody says, I'll give you $50,000 for 10% of your company, underneath all this is a discussion that needs to take place before we get to that point in time, a discussion of all of these things that we discussed, so that it's not the selling of tomatoes at a Turkish bazaar, but it's principled negotiation based on variables that we're trying to identify with lots of uncertainty associated with them. So let's do one more. I have a company, Mr. Investor, and I've been working on it for a long time in terms of developing it, and I think we can sell this company. Somebody will buy this company for $300 million. I'm going to show you lots of examples of the type of companies that Facebook bought for even more money, but I'm being really conservative, and I think they'll be able to buy us for $300 million. Okay, this is just the 500th time that I heard this, so I'm going to assign to you an internal rate of return expectation of 316%. How did I come up with the 316%? I think, based on everything that I know and historical data, that there's a 75% chance that you'll go belly up and only a 25% chance that you'll deliver the goods. So I start with the IRR. I convert that using the tool that I showed you into a return on investment expectation of 300-fold. So initially this sounds ridiculous, right? What a greedy investor. He wants 300 times his investment before he will invest in my company. Because you're at such high risk. The risk of failure is so high. And then from that, I can calculate the post-money valuation, which is the exit value divided by my return on investment expectation. Your post-money valuation is $1 million. How much are you asking me for? $250. Your pre-money valuation is $750,000. Therefore, what percent of your company am I going to ask for when I invest $250,000? A quarter. 25% of the company, and the calculation is over there, which is invisible to most of you. It's the investment made divided by the post-money valuation. The investment made divided by the post-money valuation. I'll take a quarter of your company to compensate for the risk that I'm taking for a company at your stage, is the calculation that is going through in the investor's mind. So can everybody see these numbers, even those in the back? Okay. Now, I know this looks, way too complex at the moment, but we're going to break it down into very manageable chunks here. So the first thing that I want to do is to ignore everything except just this area, only this. So this is, and ignore everything else, just this. So this is a person who comes to me and says, I have an idea. Okay, so do 1 billion other people. Therefore, the value of your company, before I make any type of investment, is $0.00. That's the pre-money valuation. I can't invest any money in you because even if I invest $1, I'd own 100% of your company. I don't want to do that. Go do something and come back later. So he says, okay, fine, I believe in it. I have the passion. I'm going to put in a tremendous amount of blood, sweat, and tears, sweat equity into this to put up a prototype or to survey a bunch of people, to talk to lots of people, to get a patent. I'll do whatever it takes to do what? To de-risk, to reduce the risk, because an idea is full of risk. So I'll do something to lower the risk. And also I'm going to put up $5,000 of my own money. This FFF is friends, family, and fools money. So I'll take $5,000 and put that into the company also. Okay? Now, the sweat equity is not yet displayed on these calculations, on this Excel. There is no numerical indication of sweat equity, even though it's much, much higher than the 5,000 cash that you're putting up. So admit that. So under these circumstances, the post-money valuation of this company is the pre-money, prior to investment, plus $5,000. Only cash talks, we're saying to this point. Don't care about how much sweat equity you put in. The post-money valuation of this company is $5,000. Okay, now the second thing, if you want to remember two things from this entire workshop, here comes the second thing. The thing that differentiates a great entrepreneur from a wannabe entrepreneur is the following. I take that $5,000 and I take now all my sweat equity, all my ingenuity, and my street smarts and my book smarts and everything else, and I reduce the risk so much with that $5,000 plus all the sweat equity that the next time I come in front of you for investment, now I say, with this $5,000, I've used it so efficiently, I've put in so much of my blood and sweat that the risk has diminished significantly enough that now the value of my company is $150,000. This $150,000 that did not come from any equation. I'm just asserting this. $150,000 valuation for my company because of how much risk reduction I was able to achieve. There are some founders who are able to do this. Use the $5,000, stretch the pennies as long as they will possibly stretch to reduce risk at the lowest cost possible so that the next cycle we have a higher investment. Now you go to investors and you say, $150,000 is my valuation. I don't have any money. I'm a poor student. I'm not going to put in any money. I need an investment of $20,000. When the investor puts in $20,000, the post-money valuation becomes $150 plus 20, $170,000. The investor now owns 11.8% of the company. How did we calculate 11.8? It's 20 divided by, not 150, but 170. 20 divided by 170. So now the seed investor owns 12% of your company. You still own 88% of your company. If you went to him at this stage and said, give me $20,000, invest $20,000 in me, because he assigned a $0 valuation on your company, he would own 20 divided by what? 20 plus 5, 25. 20 over 25. 80% of your company right off the bat. He doesn't want to do that, therefore he says goodbye. Okay, same logic now. Now you have $20,000 to play with. Now you can build a better prototype. You can apply for a provisional patent application. You can get some conditional purchase orders from people. It's all about reducing risk. So for the next stage, you say, I have really substantially reduced the risk now, and the value of my company is $1 million, and I'm looking for, what, $600,000 of investment. When people invest the $600,000, you still own 55% of the company. So this is milestone-based investing. This is the methodology to protect yourself and your equity in the company, and it's pay for performance. You reduce the risk, you get to keep more of your company. If you want my money to reduce the risk with, then I get to keep a large chunk of the company. So this is the model that the venture capital industry itself, multi-billion-dollar venture capital industry is based on nothing but this model, period. There's no magic associated with this. It's just Series A, Series B, Series C, Series D, and everybody's getting diluted. As you can see, the seed investors, as new money starts coming in, now they didn't get diluted from here, 11.8 to 13.6. Why? Because they contributed at this round another $100,000. The seed investors did. They didn't have to. We could have put in 0, and then they would have been diluted more than this. And then when they don't contribute in Series B, Series C, Series D, as you can see, from 13.6 to 10.9 to 8.4, all this dilution is going on. So for a very early stage company that comes to me, what am I thinking as an investor? First, there's the risk that they will fail outright. Then if they don't fail, I'm going to get diluted constantly over and over and over and again. And so at the exit, when the company is sold, I'm going to take not 11.8% of the company, but 7% of the company only. This is despite the fact that I put in more money on the Series A. So I have to take that into account too in terms of calculating what my return on investment might be. So this is a game of 2 seconds. So this is a game of each group, the seed investors, Series A investors, Series B investors, they're all looking downstream at the people who have ability to invest larger sums of money. So the seed investors don't have the power to invest $20 million. That's a big VC firm that's investing the $20 million. When the $20 million comes in, everybody upstream gets diluted, including the founders. The only way to prevent dilution is by what? Increasing the value of the company. How do you increase the value of the company? By making it a slam dunk for the $20 million investor, because everything has been now de-risked. When you go to a venture capital firm with a startup company, almost 100% of the time the answer you'll hear is, oh, this is too early for us. What does that mean? Too early for us means it's too risky for us. Find yourself some more risk-taking people, typically angels, de-risk it, reduce the risk, make it more of a slam dunk for us, and then we'll put in the money. So VC will say, we're money to scale. We're not money to see if it works. We're money to scale. So get your money from people who will take the huge initial risk and then come to us when you need big money to scale things up. And this is the model that shows it. You can ignore all of this intermediate calculations. I showed them to you. They were just there to enable me to make easier calculations in terms of number of shares and so on. What matters to you is the top and then the bottom. And what matters to you most is what do you end up with at the tail end of this game. So these Excel spreadsheets, I'll make them available to everybody. You can put in your own numbers and then calculate what the outcome is to you. Yes, ma'am.
Do they ever have anti-dilution provisions in them to reward people for their initial?
Yeah. So we have preemptive rights, which means if I have deep enough pockets, I can participate in every subsequent round to not dilute myself. So that would be an anti-dilution provision. But the assumption is that I have deep enough pockets to participate in a $20 million round, which I may not be able to. We could put in a clause that says you can never dilute me, right? So 12%. Well, that's a poison pill for the company because nobody else will invest. So the game that we're playing is not make the company uninvestable for subsequent rounds, and yet protect ourselves and not get, it's called a cram down, pushing the angels into accepting the terms of the bigger boys. So these people, each of them have to protect themselves. Who has to protect themselves the most? It's the founder, obviously, right? So, and even from an investor's point of view, the more under normal circumstances, the more you can delay outside investment, the better off you will be. Why? The assumption is that you will be able to de-risk it and you're going to increase the valuation of your company. The higher the risk, the more you'll be penalized by giving up more of your equity. I'll come back to you in just 2 seconds. Yes, ma'am.
Okay, so River
West, yeah.
Last night they said in their biomedical, they said they wanted people to come pre-revenue because after revenue it was too late for them.
Right. So
what does that mean?
So well, I'll say it, but it can't leave this room other than the video and the YouTube and everybody talking. It smells a little bit of desperation, right? So there is so much competition between VC firms and incubators, accelerators, and so on and so forth that everybody is looking for good deals. So what's happening now is, in order to make sure that they don't miss a Facebook, they're willing to, and I'm not isolating River West, everybody is doing this. So the idea is I'm going to invest in 25 companies. There's got to be a Facebook in there, and that one will cover all my losses, so I can't miss any opportunity. That's kind of consistent with the the bubble mentality of the country, right? So let's just do 20, and then maybe there will be one hit.
So their payout is bigger.
They're hoping that the payout is going to be bigger, and maybe it's this one that will deliver the big payout, so let's not miss out on it. So let's just invest in it. And what they're saying is that if we wait and somebody else invests, and we have to participate in this round, we don't have enough money to participate in this round. So people are beginning to move upstream to lower valuations. So this trade-off is very important for those of you who have studied medicine. False positive, bad investment, versus, false positive, I missed a Facebook, versus false negative, oops, I made yet another silly investment, is what's going on in the investor's mind. I can't miss a Facebook because that's the only way I'm going to cover my 75% failure rate, and keep making investments and keep losing money, and your spouse is complaining to you every day about, I thought you were smart, what's going on here? And again, back to human psychology. Yeah.
So if someone was brought into the company with vesting interest,
yeah.
And then before the time that they would earn their interest, there was an outside investment into the company.
Yeah.
Then how do you determine?
Yeah.
Like, is it diluted or
Yeah.
is it
Yeah.
at the
Yeah.
Postmoney?
So when we come in at any stage, like if we come in as seed investors, and I'll show you one of these, I don't know what the time is, but we declare, demand, negotiate, whatever you want to call it, that the company set up an option pool. So typically when we come in, we'll say the company has to reserve 10% of its shares in an option pool for key employees. When the next money comes in, and some of them may vest by the time the next money comes in, when the next money comes in, there's always an option pool made available so that you can attract key employees. So that's another dilution factor to the founders, that the existence of that option pool. I'll discuss it in another document, but so as not to complicate this any further, I did not put the option pool nuance in this spreadsheet. Any other questions? Yes, sir.
So the only way that you are changing the pre-money valuation, if you presented three scenarios where it's just an idea, you have a prototype, you have a customer. The only way that you're changing the pre-money valuation is by changing the expected IRR.
So the only way you're going to move your pre-money valuation is by reducing the perception of risk by the investor.
Yeah, but how do you quantify that in terms of
Yeah.
expected IRR?
So there is no formula to quantify it. It's all based on comparables. A VC firm kind of knows. There are ways to quantify it. I don't know if they're here. Save your question, because I think I'm going to hit it in a couple of new slides, okay? Just save your question. How do you quantify the reduction in risk is your question. So registered in the back here. Hopefully it won't slip out, but I'll try to hit that one. But one way we do it is by benchmarking. So these folks, for example, have a technology, a brand new technology in the environmental sciences field, let's say. So I look at other companies as an investor, and the founder should do this too, and I try to find 4 or 5 benchmark companies that are very similar, but obviously not exactly the same as theirs. The technology doesn't matter. The vertical matters. To whom are we selling? What type of new product are we selling? And then we have this type of data available to us that we pay for, which is, so these guys had, this particular company had, a seed round in 2002 of $300,000. Then they borrowed some money, $750,000. Series A, VC came in at $2.05 million, you get the picture. Pre-money valuations are given, post-money valuations are given. So because we have access to these, we say, okay, did this end up with a good story or a bad story? But this is the type of money that they probably will end up needing. We're much more comfortable with benchmark data than what the founders tell us. So the founders say, oh, I think we're going to need, $500,000. Okay, how'd you do that? I summed everything up. You know, this is the cost of the resistors, the equipment, and so on. It's much safer for us to go to a benchmark and see how much they spent, especially in big deals, right? You know, like development of a pharmaceutical or something like that. But even if you're opening up a restaurant, I'd be much more comfortable looking at benchmark numbers than your numbers. Why? Because benchmark numbers represent reality, whereas your numbers are projected numbers. Okay. Great. Back to your question. In some cases, it's much easier for us to quantify risk. And in some cases, it's much, much more difficult. In this case, for instance, look at this here. Historical probability of taking a project from end of each given stage to the marketplace. So this is for pharmaceuticals. Much easier to understand and to deal with. Some of you may already be familiar with this. Discovery is we're in the lab, we're trying to find the right type of proteins, blah, blah. Preclinical, we're testing it with small animals. Phase 1, we're testing to see that it's safe. Phase 2, we're testing it for efficacy. And then Phase 3, we're testing it with a large population for efficacy. Look at these incredibly depressing numbers. If you come to me and say, I found a great new protein, it could be a drug. Have you tested it in animals? No. Have you tested it in humans? Of course not. I haven't even tested it in small animals. The probability that that will fail is 96%. But I tested it in small animals. Great. Probability of failure is 92%. But I also tested that it's safe. So can you imagine the type of risks that are being taken? And Michael Kinch, my colleague here at Washington University, has been analyzing the amount of investment that's going into pharma, and it's really scary. So it went up like this, and now it's halfway on its way down. It's just too risky. It's too expensive, and the failure rates are just too high. So the country has to deal with this somehow or another. Long answer to your question. In the case of an e-commerce company, let's pick a very simple one. How do I quantify risk? Again, I go back to benchmarks. So what I look at is how many users were you able to create in a given time frame, and what is the rate of acceleration of user pickup? And then I look at the successful ones, the ones that did not die, and are you duplicating their performance? And that's a risk mitigating factor. So there's a lot of, not even art, there's a lot of psychology associated with this. It's not possible to squeeze these things into pure numbers. In some cases, we can get some inkling of these types of numbers. So I know that there are many of you here who are working on more lifestyle type companies, possibly, as opposed to these, pharmaceuticals and large-scale operations. But the fundamentals apply to everybody. So this is actual data. Let's start with the red one first, okay? So the red one is risk of failure. And these are historical data. So this is reality. It's not somebody that put it up there. So the risk of failure versus years. 14 years to exit. That's typical for a pharmaceutical. That's why I would be very hesitant to invest in pharmaceuticals, because I'll probably be dead by the time there's an exit and I don't have any kids. But the way the risk comes down is known. So this axis, this risk of failure, is associated with the red line. Company value is the gray line. So the company value starts increasing, and it has this inflection point where it really takes a turn and starts going up. In other words, that's where people are going to wait until they invest. So VC is going to say, you're too early for us. They're just waiting for you to get to this point before they invest. And then this line is the cumulative cost. Of course, the axis is 50 million, so we're talking about some serious money here, even though the line is pretty close to what looks like 0. So these are the type of analytical approaches that we attempt to impose, but we're still betting, right? 75% failure rate is a bad enough rate. So the way we try to impose some logic onto this, and this will again be repetition from prior workshops a little bit. Many of you may have heard this before. So my personal approach is this. Credit card companies can guess pretty well the likelihood that he's going to default on a credit card. So we know that the global default rate is 75%, and we haven't been able to crack that nut. So can we do some things to find out which ones are more likely to default, and in the case of startups, which ones are more likely to fail in a numerical way, just like the credit card industry does or the life insurance industry does. So my pet project is the following: a national database of performance metrics from existing startups on as granular a silo-based system as possible. Again, much easier to tell you by example. You come to me and you say, I have designed this medical device. It is non-invasive. You don't have to do anything with the patient. It's outside of the patient. And the FDA treats it as a so-called class 2 device, minimal risk to the patient. And I'm giving you my financial projections, which says that we'll take it through the FDA in 6 months and we'll spend $200,000 to get it through the FDA. I go to my magical national database that does not exist yet, and I look at the distribution of companies similar to yours, minimally invasive device for this purpose, and I say the mean was 18 months, not 6 months, and the mean was $500,000 and not $200,000. So before we invest in you, before we launch your company, let's first make sure that you're not a total outlier. Tell me, how did you come up with 6 months? Maybe you have a legitimate answer, or you're just guessing. So this tool, these series of tools are designed to impose a sanity check and a correction mechanism so that we're making our bets much more carefully based on benchmark performance. Now, VC has its own database. When you go to a VC, typical VC, they'll say, we only invest in diagnostics. We won't invest in therapeutics. And in diagnostics, we only invest in neurology and nothing else. Why are they saying that? Because they have their own little database that they have accumulated that is very proprietary to them, that they won't share with anybody else. That's a domain that they understand, so that they call their wheelhouse. It's in my wheelhouse. There is no national database wheelhouse, and my argument is that Washington University can be the depository of a national database of that type because it has the credibility, objectivity, rigor, and everything else. So as everybody else, we're applying for grants to give us money so that we can set up the database. So hopefully I won't be dead by the time the database comes along, because you know how grants go. But we are, starting to dabble around a little bit about bringing some science into the world of investment. I know I threw a whole bunch of stuff at you already. I hope that the fundamental thinking process is clear. But in the small amount of time that I have, I want to show you one more thing. So this is a typical term sheet. This is the document that defines the terms under which we'll make an investment in you. And I want to point out to you some of the stuff that's buried in the legalese that map onto the presentation that I just gave you. So we will invest, the investors say, a minimum of $50,000 and a maximum of $60,000 in your company. Why this range, $50,000, $60,000? It doesn't have to be there, but Scandlera's seed fund is going to invest at least the $50,000, and then if a few other people who we think are critical to the success of the company, if they want to come in, we'll let them come in also with another $10,000. Again, I'm going to skip terminology and so on. There's some layers of the onion. What's a Series A preferred, blah, blah. So the original purchase price, pre-money valuation of $450,000. So that's defined in this document also. So when we invest the $50,000, we're going to own 50 over 500, 10% of this company. To your question, we say there will be an option pool of 10% reserved for key employees. So we impose that on the company also. Okay, so board of directors, the company will have 5 board members. So these are the decision makers of the company. And we say 3 of those will be the investors and 2 of those will be the founders. So you shouldn't worry about, oh, I need to keep 51% of the company. That has nothing to do with control. Control and ownership are different things. Ownership, you can own 20% of the company and control the company. Is it that we're trying to control the company? No, especially under these circumstances, in a university fund setting. It is just that we see the risk as being execution risk. In other words, if the founders were, let's say, not students, but they had already launched and exited 5 companies, we might not have this clause. This clause is there to make sure that we can reduce execution risk. The board is going to decide what is the right thing to do, and the investors are going to have a majority decision. That doesn't mean that we're not going to listen to the founders, because frankly, the thing that the investors are terrified about is the founders leaving. So there is this trade-off between, will they walk away, in which case we wasted our money, and there's nothing, because we're not in it to run companies. We're in it to invest money and then look from far above and make sure that everything is going properly at the high level. All of these are designed to protect the investors. For example, if the company goes bankrupt, the first money out goes to the investors. Let's see what others are of importance. So typically, 80% is boilerplate, and so drag along, for instance. This is yet another way of the investors, as the name implies, the investors can drag the founders. If the investors say, let's sell this company, and the founders don't want to sell the company, the investors can drag the founders to sell the company, for example. Redemption rights. So this is also critical, right? So what this says is that the investors have the right, but not the obligation, to force the company to buy back the investor's shares at twice what the investors paid for them in, say, 3 years. Now, if the company doesn't have the money to do so, so this is, the investors want to hold all the cards, but they will not be necessarily playing all the cards, but they want to hold all the cards because of the golden rule, number one, and because they're afraid that the investors downstream from them are going to take advantage of the people who took the original risk. In other words, VC is in an interesting position. They have access to a lot of money, but they're unwilling to take the original risk. The people who take the highest original risk have a right to say, we took the original risk, we made this, we enabled you to invest in this company at this much later stage, but the philosophy is, forget about the past, let's talk about today, is what the VC is going to say. You need the 20 million now, otherwise this company is not going to go anywhere. So we're trying to make sure that the original people who took the initial risk are protected. Against whom? Against downstream investors. Founder vesting is also an important issue that you should think about if you're starting a company. Let's assume, 3 of you started a company and you said, 1/3, 1/3, 1/3. Great. Okay, we're all friends, and each one of us own 30% of the company, 33% of the company. And then, the next day, one of the three falls in love, moves to California, and he walked away with 1/3 of the company. So to avoid that situation, what we do is you earn your shares over a period of time. So let's say over 3 years, you get 10% of the company each year, so that if you leave, you don't walk away with half the company. So in our case, 36 months of vesting, even for the founders. So we do other silly things, I guess. We'll take an insurance against the founder, because if he gets hit with a bus, we need our money back. And there's insurance, actually Keyman Insurance, that insurance company will pay us our money back under those circumstances. And then we have this, capitalization table, which is kind of similar to the one that I showed you before, including the option pool and so on. And that shows very clearly what percent of the company each individual or the investors own. Any questions? I'm wearing multiple hats here, and I realize it. So I'm wearing the hat of an investor. I'm wearing the hat of a founder. I'm wearing the hat of something like an educator. So I can put myself in any shoe that you like, but I'm kind of bound by my personal history, which is when I bet on myself, 3 times in a row, had a hit, and then I lost about 4% of the money that I made in angel investments. That wasn't too pleasant, but I got much, much better, and the only way that I got better is by deploying this strategy, which is, silly money, easy money corrupts, and careful money, hard money teaches, is my belief now after having gone through these experiences. Questions? Any questions at all? Particularly from those that are not trying to go this scale, and points where this type of thinking and methodology does not apply, because I think it applies everywhere. Even if you're just building one coffee shop in a street corner, the same thinking and methodology applies. Yes, ma'am.
I'm really curious how you value companies that are predominantly social based.
Great question.
Especially when it's not an advertising.
Yeah. So for difficult questions, I start my answers with it depends. In your case, it depends, right? So it depends on the investor and the stage of the investor. So some investors are still in the wealth building mode, and they will just look at the bottom line and the return on investment. Now their philosophy is the following, which is also a viable philosophy, which is I will maximize my wealth and then I will do philanthropic things. If I commingle philanthropic activity with return-driven activity, then I'll cause damage to both. So there are some investors who keep that in mind. They are philanthropic, they don't need to build any more wealth, but if they make more wealth, it's for philanthropic purposes, class 1. Class 2, there are people who are really interested in social impact, truly. What I've observed is most of those people made their money by focusing on the bottom line and only the bottom line, and then they encourage young people to have, social impact. Sometimes I tell them, well, how about we give them a chance to build wealth too, and then they can, like you, focus on social impact. So there are investors who will invest selectively in things that have social impact. There are others who are, and the younger generation, I think, is latching onto this, the Tom Shoes model, which is we can make money and do good at the same time. Again, being an engineer, I'm a person of probabilities, right? So it's a function of where society is. In order for Tom Shoes to be successful, you have to persuade consumers to pay 20% more for a shoe because it's doing good. Otherwise, somebody else is going to come in and wipe out Tom Shoes. So it's a function of where society is, and as society moves in that direction, I'm willing to give a premium to do good, then more of those companies are going to be successful. danced around the question a little bit, but yeah. Any other questions? Yes, sir.
In a case where you've got a startup where it's funded by an endemic, right?
A who?
An endemic,
Mm-hmm.
right? So you get an idea in sporting goods, for instance, and you get Rawlings to, or in this case, Jarden, their parent company, to invest. Are there ways of limiting the control or forcing an
Yeah,
option
yeah.
in that situation? So you think we've got a good idea, but it's relatively
Yeah.
unproven.
Yeah.
They've got some sort of internal
Yeah.
venture pool.
Yeah.
And at some point, they've either got to
Yeah.
buy you in.
Yeah. So again, once again, and it depends answer, right? So what you have to weigh is if you can get away with not giving them equity, that is far better. So for example, we're dealing with a case where there is a situation like this, giving them a exclusivity for a limited period over a limited use base. So for example, we'll give you exclusivity for 5 years for this region in exchange for whatever you're giving, but we don't want to give equity because we want to keep our options open. It's a very difficult question, of course, because you will make yourself less investable, less exitable, and if you had an exit, less valuable because of the decisions that you made at the front end of the business. So it's another difficult question. Has to be determined on a case-by-case basis, unfortunately. Yeah. Yes, ma'am?
Could you maybe suggest some resources for someone looking for the whole user's time frame so that you could do a valuation for your e-commerce or technical IT projects?
Well, I can recommend a resource, a great resource. It's called Google. The problem is, Google knows everything, but the problem is it knows everything, right? How do you sort this stuff out?
I'll tell you, a lot of what I've found already is for the extreme success stories
Yeah,
and the failures.
yeah,
And for the projects or companies in between, there's not a lot because they keep it close to the breast.
exactly right. In fact, more talk on the successes than the failures. One of the things that we were talking about with my colleagues here was to have a journal of failed startups. I think it would be extremely popular because it addresses 75% of the population, right?
Website.
Is there one? Okay, yeah.
New York Times.
Yeah. Yeah, I think you're hitting on something, the limitation, right? If we think as a country as to how do we make this stuff, more efficient and increase the success rate and so on, and unfortunately the bottleneck is the people who have done it before and willing to give back, because those who have done it before don't want to be bothered by joining a university and so on and so forth, because they already made their money and they have lots of flexibility. And so I don't know how we're going to crack that nut. We need successful people who can relate back to where they were when they started and then see themselves in the people who are at the beginning stages and somehow give a little back. And that's, I think, where the bottleneck is. It's a very retail business, like mentorship, apprenticeship. It's not automated by any means yet. WashU is working, quite hard on, Scandler Center is working very hard at some level of semi-automation. So we get also flooded by requests for assistance. I personally do. So my solution was I have like grades of homework assignments, right? From the easiest to the most sophisticated. And I just shoot off a homework assignment that I think is comparable to where that person is. And if they don't come back, they self-eliminate it. And if they come back with a great answer, I give them the next harder assignment and harder assignment. And the assignment is very practical, very real, but it allows me to track without having to handhold where that person is with respect to knowledge practical knowledge. Because otherwise, total retail is impossible. Yeah. There has to be some means of automated solutions, yeah.
Can you speak more to, like, if you're the founder and you're at the negotiating table with an investor and they're armed with their database and their benchmarks, what kind of leverage do you have, or what can you do to kind of
Right.
push back?
Right. Well, let's see. So the easiest answer is if you had infinite time and you can leverage the university's resources. So the Scandlaris Center has, subscriptions, paid subscriptions to these types of databases that are not available, from the library, for example. So if I were you, I'd leverage all the resources that the university gives you, number one. Number two, I think your choice of initial investors are going to be very critical because, first layer of the onion, because under certain circumstances, which I'll get into in a second, what you want to do is for the seed investors and yourself to be sitting on the same side of the table when it comes to negotiating with downstream larger investors, so that you and the seed investor are facing the same rate of dilution. We have the same objective to increase the valuation of the company as much as possible before going out to these VC that has much more money available to them. Now, there are circumstances where the seed investor and the founder end up sitting at the opposite sides of the table. This is why I hate convertible loans. Because a convertible loan, I won't get into the details, forces the founder and the investor to be sitting at the opposite sides of the table. That's a terrible way to start a great relationship, without which our odds are already small enough. We don't need to create any more tension between the founder and the investor. So I myself personally will never go into any convertible loan operation. I'll pass 60 of them. Doesn't matter, just won't do it. For that reason, to put the founder and the investor on the same side of the table. Any other questions? Yes, sir.
Final one, kind of a follow-up to both the prior ones. Every founder tends to think their company is sui generis, right? It's its own thing and it's a special snowflake. But you've, I guess, touched upon multiple times the importance of the benchmarking, and his question spoke to that as well. It seems like who you bring to the table as your benchmarks is important.
Absolutely.
And as colleague over here to the left brought up, you tend to see the U-shaped distribution publicized, right? You get pets.com on one side, you got Facebook on the other.
Right.
And you don't have hundreds of perfectly sort of adequate mid-performing ones. How would you one favorably define your cohort, right? Because you want to pick benchmarks
Yeah.
that speak to at least the potential for
Yeah.
success, and then where the resources,
Yeah.
Google notwithstanding,
Yeah. Yeah.
to find ones that
Yeah.
that make sense.
Understood. So let me try to answer the question with an example. So student ventures teams will come to me, and when we're analyzing their numbers, they'll say something like, our cost of customer acquisition starts off at $15, and as we gain word of mouth and so on, it drops to, let's say, $6, right? Now, this is why the database is so necessary. In my own internal database, I have the Groupon data, which show that the Groupon's cost of customer acquisition went from $7 to $54, even though they were gaining lots of name recognition. Why? Because they were very interested in growing their user base as quickly as possible, and so they were reaching for the higher hanging fruit. So the next layer of question I would ask the founder is, what is your market penetration rate assumption here that justifies a declining cost of customer acquisition? Because we have seen that if you're showing this type of growth, then you better crank up that cost of customer acquisition too. That's what we have seen with every other company. So we're checking for internal consistencies mostly, and then some external benchmarks. And the unfortunate thing is, each person, each so-called sophisticated investor, etc., has his own little database that he's tapping into, and he says, I'll pass on this, not in my wheelhouse, because he just doesn't have the data. But somebody else next door has the data. So pooling of this data is a way to, I think, really open up this field in a significant way. Because I know about Groupon, next guy knows about 5 other companies, and they're not in one depository. And I don't quite understand why it has not happened. Why did we... information, everybody is arguing that information wants to be free and everything is available now, information this, information that. How come there's not a single database of performance metrics for all startups that were ever created?
Well, I think there's some incentives too for the guys that know.
Sure.
Not just Groupon, but as you say, 60 others.
Sure.
The information wants to be free, but it also wants to be very, very expensive.
Right, exactly. So that's, consistent, I would say, with the mission of a university that wants to be known as an entrepreneurial university. It's right in their sweet spot, I think. So I got to convince some funding agency to say, wow, this makes sense, let's go for it. So I wish the chancellor was in the audience, but he's not, so.
What about insurance companies? Would they be interested in?
What's in it for them? I think the only entity that says there's something in it for us is the federal government probably, or like a Kaufman Foundation, because, who benefits? The nation benefits. And therefore, automatically, it kind of limits the available funders, right? Because the insurance company will say, well, I have a fiducial duty to my shareholders, and what is this going to do for me? I'm going to help out everybody else. Sounds good. Yeah, I think our targets are federal government and foundations, I suspect.
Well, we should package it and sell it off to VCs.
Yeah, so we could. I could start a company to do that, but beyond that phase, it could be done. Somebody could do it. One of you could do it. Yeah.
What about one tier below, like the RCGA or St. Louis Economic Development?
Yeah.
Fund here, like writ large, right?
Yeah.
Milwaukee's got one, Cincinnati's got one.
Yeah. So the difficulty, I think, is data has to come from everywhere to make this useful, and locking up the data to benefit just one region is going to make it unattractive for people to give you data. So we have to play some games about, you give me data and I'll give you benchmark aggregated results back to you. I think another low-hanging fruit is angel investors who have wasted tremendous amounts of money in this game. And so they can force their portfolio companies to give this data back to this national database, but it has to come with the credibility of a WashU.
With angel investors, in your experience, where do you find that they're learning how to invest?
Yeah, so I've been one for 15 years in Tucson, Arizona. And unfortunately for them, most of them had made their money by their grandfather having bought some land in Arizona and sat in it long enough, and now excess money to invest. Young people, angel investing sounds like fun. And so that's how everybody lost a chunk of money, including myself. That's why the country is polarized, right? So Silicon Valley now knows how to do this thing, and everybody else is still learning. And yet again, a need for that educational component, I think. We need, instead of, more so than wealth, we need astuteness and the belief that, easy money corrupts, hard money teaches. Those are the type of people that we want. Even if you're philanthropic, be as hard as you possibly can with founders. That's the only way you're going to do good. If you confuse the founders by just, throwing money at them and then saying, I'll wait for a Facebook to pop up from my portfolio, you're just doing damage and disservice to everybody, in my opinion. But that's the status quo. That's the portfolio management theory that everybody's taught. Yeah.
So, according to you, what are the most important or most common factors for 75% of these startups which are VC backed?
Failure modes? Yeah.
75%.
Sure. So the saying is that there is one startup killer, the biggest startup killer. The biggest startup killer is, turns out, surprisingly, cost of customer acquisition. In other words, it's not, you can build the technology easy enough. You just have to throw enough money at it. But there are some circumstances in which the customers are so unwilling to pay for your product that to buy, cost of customer acquisition is an admission that we have to pay for and buy customers. We have to put TV ads, we have to go to trade shows, we have to give demos. And what happens is it becomes so expensive to buy the next customer that the profit that your product generates is inadequate to compensate you for all the expenses that you spent buying those customers. So VC industry, angel industry, everybody who's in this game will say to you that the primary startup killer is cost of customer acquisition. And it's not purely a function of, well, if we, we're not doing good marketing, that's why our cost of customer acquisition must be high. That's a, level 6 type thing. The primary thing is you didn't find the best match between those that really need your product and what your product does. You're trying to force it, and that's why you're paying a lot of money to bring this guy out here to have the connection between what the customer wants and what you're selling. So discovering that as early as possible is key without wasting a ton of money. Any other questions, comments, pushback? Not at all. Cool. Okay, what time is it?
Actually, do you have a question? The material
Yeah.
that you presented here today, is that going to be made available?
So anybody from Scandalaris here? Just me. So we have I think if you signed up your email address, then we do a blast of all the materials that I showed you here to anybody who put down their emails. If somehow you don't get it, just shoot back an email. You can send it to me, Toker, T-O-K-E-R, @Worcester.edu, T-O-K-E-R. Yeah, if you could fill in the surveys too, that's useful for us because we're trying to keep track of how, whether the content is right and so on. Okay, thank you much, appreciate it. Yep, thank you.